Good morning, everybody. I'm assuming everyone can hear me okay. You see my screen just fine. This is Gil. It is just after the opening bell on the last trading day of the week. Actually, we get the jobs number tomorrow, but we are going to be closed. U.S. markets will be closed tomorrow, so it'll be interesting to see what happens. Right now what's going on, the model went to a neutral signal yesterday, and that's based on the big gap down. You've also had, if you can see here, here's this little distribution like churning at the peak, pick up volume the next day. I actually show on this day volume is higher. I'm not sure why eSignal shows a lower volume bar, but I actually showed it just a pinch higher. Don't you, Dr. K? Do you show that?
Yeah, that's right. I'm showing the same.
Yeah, so in fact, you get a down day here and volume picking up again, and then another down day here, even though you close up off the lows. That's why it's blue. That's why I have that color coded like that. And you do close off the low, so it looks like supporting action a little bit, and it tries to rally. You don't really get the volume, and then you pick up volume in yesterday, and I think Monday as well, which is more of a churning day because you did try to go higher. So coming down, the thing is, the market's been in a big uptrend, and so it's entitled to go sideways here for a period of time. So I'm not going to jump in and say that you need to be shorting the market here, because there aren't a lot of short sale setups. There's a few things, and I'll look at them a little bit later, that I'm watching here. But I think you're really looking for a bear market to really start, and really the thing to do, for those of you who read How to Make Money Selling Stocks Short, which is a book I wrote with Bill O'Neill on short selling, you're waiting for the first break off the peak, and then the market will start to rally, and so that's kind of what we're looking for here. Right now you're holding this support level. You see something similar on the S&P, so it's not really clear whether it's going to break down or not. So that said, I don't think you're selling all your stocks. You're not running for the hills. If you have a stock that's acting well, and we'll look at several of those, and there are several acting okay, or at least within the boundaries of the risk parameters that we set for the positions when we took them, at least on our end. There are a couple of exceptions, and I'll get to those. But for the most part, you want to kind of watch to see how this develops, because while the indexes might be stuck in neutral, leading stocks might continue higher. And yesterday you saw some of that with Apple seems to be acting fine. Priceline had a couple of pocket pivots in a row, and it's acting fine. But in terms of the model, Dr. K, any comments to add there?
Well, we've had, I use the Wanda volume bars, and we've had 6 distribution days out of the last 7 trading days, not counting today, of course. And you have European markets that are breaking their uptrend, and so there's certainly some bearish implications for the model. However, it is still on a neutral. Leading stocks are acting okay. I mean, they're acting better than okay. So right now the model remains firmly in neutral, but there's, it doesn't take much for it to push it into a sell signal from where things are at right now.
Yeah, and I think if we do get a sell signal, our plan right now is to do a mixture of TZA and QID.
Well, no, actually, TZA and the emerging market, European emerging markets, because those are the markets that get hit the most.
All right, so you changed that overnight. Okay, that's fine.
Yeah.
Either way, but that you can do it however you want.
QID is actually very strong. The Nasdaq 100 and the Nasdaq Composite have been the leading indices, and partly due to Apple, and Apple is being a leading stock is still showing a lot of strength. So should the model go to sell, I think the best bets are averages that ETFs that are related to the Russell 2000, which tends to get hit the most when the market declines in terms of U.S. markets, and then any European-related markets, since troubles seem to be brewing over there, renewed troubles in Italy and Spain.
Okay, what was the inverse European ETF?
That's EDZ, Echo David Zebra. That's the three times bearish MSCI European Emerging Markets ETF. Now there are 1x and 2x ones, but they tend to be really thin. So I would recommend using the EDZ and just position sizing according to your risk tolerance.
We get some questions about the old TVIX. The TVIX had some issues. From what I understand, it plummeted here. And that wasn't really, I don't think that was related to something with the NAV. So these ETFs are a little funky. This one is the one that tends to be more coherent. So we're keeping an eye on this one as well, possibly. But You made an observation, though, Dr. K, that it's best probably to wait for this thing to bounce, get up through the 30 area on the UVXY, or you're looking at the TVIX?
On the VIX index itself, just the VIX,
Okay.
when it gets above 30 historically, that tends to be unusually high for it. And so I'm still carrying out these studies that are, there could be some light at the end of the tunnel, let's just say. Because essentially when the VIX is not above 30 and it's just kind of doing its thing, and it tends to go lower over a period of time. So you would think, therefore, that the TVIX, you could short the TVIX and make money off it too going lower. But unfortunately, there's not a direct correlation, and there seems to be a lot more risk getting involved with TVIX or UVXY when the VIX is not at unusually high levels.
Okay.
And then it's very squirrely what TVIX did in terms of the market making going on. It's very odd what it did on March 22nd to the 26th, those 3 trading days where it just tanked. It lost, it looks like it lost 2/3 of its value in 3 days, whereas UVXY seems to be a lot more stable.
Yeah. So that would be the one that I'd probably go for. I actually have been trading this a little bit off the lows. You'll get on a day where the market starts to break and you want to hold your longs. I've noticed if I take a 20% position in this, it hedges pretty nicely because you get a good 10, sometimes 20% move in a day. But it's still very volatile, so you got to keep it, run it very close to the vest, so to speak. So, but I notice that if the market does start to come off, and I'm long, 2 or 3 leaders that are hanging in there, and I want to stay with them. Just throw out a 10-20% position in this, go long this, and I notice it's not a bad hedge because it tends to move up sharply when the market starts to come off sharply. And even if your leading stocks are holding it, it's kind of like just a little bit of gravy. Some people are showing, let's see, some people are asking about the one on everybody's mind, InvenSense. Right now, you close below the 50-day moving average, so technically, if it moves below the low of this low here, it's a sell. So what happens, though, coming down, I think I talked about this last week, the way I play something like this, I'm looking, if I'm picking up off of here and then picking it up, coming off of here and up here, and then on this pocket pivot, it starts to fail, I'm backing away very quickly. So I'm cutting the position down, 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 down. And in a very aggressive account, I'm already out of this thing once it starts to come down through the 10-day moving average. In a slower account where I'm running more of a core position that's bought mostly down here, you peel off until you're down to a core position. But that could be sold off if the market or not, if the stock breaks the 1607 low from yesterday, because that would be a violation. So right now it's trying to back down a little bit. Volume isn't terribly heavy from what I can tell right now. Well, it's running 128% above average right now, so it is somewhat heavy. Market's coming off, though, kind of looking for a reaction bounce here before it violates this. But that's kind of where you're at. If you bought a position in here and you may be slightly underwater on your core position, but we'd be cutting it back on the way down, which is what we're doing. But we'd be looking for some kind of reaction bounce. But all you can do is stick to your rules here. There's no magic here. I know everybody wants, what is your opinion of InvenSense? Like, we have a crystal ball and we can tell you that's going to bounce straight back up to the highs. No idea. All we know is what we expected this thing to do, it has not done. And based on the rules that we would employ for the position, you're cutting it back on the way down. And so it's pretty simple, pretty straightforward as I see it. And, in the meantime, you have stocks like LinkedIn, nice shakeout right off the 20-day moving average and doesn't get below the low of the gap up day. I'd allow for a little bit of a drift below here, but it's holding right now. Actually, a nice shakeout this morning. I'm still long this thing, so we're not running away from everything we have because we have some stocks that act okay. And sure, you take a little bit of heat on the positions that you have that are coming off like InvenSense, but there's some other stocks still in position. They could go a lot higher. You can make a lot of money very quickly if for some reason this turns out to be a shakeout. But with all the distribution, we're leaning towards being neutral on the indexes here based on the model, but leading stocks are hanging in there. Some Monster holding the 10-day moving average. It doesn't tend to hold the 10-day. I noticed that it doesn't violate the 20-day, and there are rare instances where that happens. Whether that's a reliable selling guide, if it violates the 20-day, is another question, because by then the 50-day may be up somewhere in here, so that becomes a reliable selling guide as well. And I think, Dr. K, you would use the 50-day on this one, right?
That's right.
Yeah.
until it shows that it can sustain itself for at least 7 weeks. Sorry, if it can, yeah, if it can sustain itself for at least 7 weeks without violating the 10-day, then I switch to using the 10-day as my sell guide.
Yeah. Oh, let's see. What other ones look okay? I mean, Biogen looks okay. We actually do still own this, Dr. K. So it's holding in and pulling back to the 10-day. You got some volume yesterday on this, but it broke out and it's moving up. So this is actually acting okay, and don't really have an issue with this right now. There are some others, Alexion. I think I told you guys this last week too, is that I know that Will Damoff and Contrafund has a big position in this, and I know one thing he'll do is come in and just whack it sometimes and then just go away, and then it drifts back up to the highs. Now it's trying to stabilize, so it might still be okay, but something you'll notice about Alexion is that it holds the 20-day moving average, and it held the 20-day moving average here again. So, if you want to run a real tight stop and it makes you feel better, I guess you could try to use the 20-day moving average. And in some stocks, and as well as the silver ETF a couple of years ago, or even last year, the 20-day moving average actually serves as a very reliable guide. But they're very rare instances, and a lot of times there's not too much difference though between just using the 10-day and the 50-day. It's kind of like 6 of one and half a dozen of the other, depending on what your risk preferences are. But I think with Alexion, the 20-day looks to me like a reliable guide. Dr. K, how would you handle this if you're still in the stock?
Well, I mean, it technically it had a 10-day violation on February 21st.
Right.
Very mild one. But because it did that within 7 weeks, I would be using the 50-day. That's my selling guide here.
So you're all the way down to 85 if it pulls back. So, if you're running a really aggressive position, like I might be, I would use a 20-day myself, but that's just my preference. And it's only because I noticed that it holds 20-day. It tends to, and it has done so. And I want to run a tight stop if you're running a big position. If you're running more of a, say, normal size pyramidal position like this on the way up here, then I think that's a reliable guide. It takes you right on top of here. So, in this market, sometimes you're better off giving things a little more room, and you can see that has often been the case with Alexion on the pullback. So that's kind of.
I think also Alexion, what I notice is when it violates the 20-day, it's right on top of the 50-day. So the 50-day then serves as support, and then it tends to go higher. That's basically why I stick to the 50-day in this case. And there's one case where it. There's only one case in the pattern where it did break below the 20-day and then the 50-day, but then the 20-day and the 50-day were very close together, and that was several months ago.
Right, and that's what I was saying. If you get into this debate about using the 20-day or the 50, a lot of times, like I said, it's like 6 of one, half a dozen of the other. It's not that big of a difference. So,
what I didn't like was Alexion the other day, how it just had this huge sell-off. So, big seller came in and just plunked the stock. And that was out of character. It hadn't had that kind of wide-ranging day ever, or on the downside anyway. I don't think it's had that kind of wide-ranging day. So that often is a clue that maybe there's something not quite right with the stock. And at that point in time, we're talking several days ago, there were other stocks that looked better that weren't spinning out like that one.
Right. Salix Pharmaceuticals is just the breakout's holding tight, so there's not really much to think about that. Somebody said LinkedIn is your full stop still at the BGU of, well, I think that's 97.01. You would use that 97.01 low on LinkedIn as your stop. But see, here's the other thing here. It tends to be a volatile stock, so I could see it dropping a little bit below, and you see it already did it once before. So, you could use 95. From here, what is that, 4%?
Yeah, you use like 96 and change. This just undercuts that low of that second day. 96.6 is that low.
96.60. Okay.
Yeah, you could use 90. Yeah, you could go 90. You could go 90. 90, 96, something like that. 1 to 2% porosity on the low of the gap up day is pretty typical. Although I would say that once the stock has done what LinkedIn's done, if it comes back around after several days and then undercuts that low, generally it's best to sell it. That's why we keep the stop pretty tight. Keep it just under 96.6.
I think we're going to go through some questions. I think that's probably the most useful thing that we can do this morning. Okay, as soon as I get through all the good mornings, can you talk about your thoughts on the spin out of Tango on the secondary. Well, I can tell you real quickly, no real thoughts here. Our feeling was that we had a position in this thing, and we sat through this, okay? And you watch it go, but it's a good reason why a lot of times I don't even watch the screen. But I triggered an alert, and you come back, and the alert's been triggered, and look at your screen, notice it's back up to where it was. So what we decided was just to blow it out up here and back away, because we just don't like this. Dr. K, any thoughts there?
Jazz did something like that in April of last year, and after it did that, you just don't touch the stock for a number of months, because something's going on with the way the markets are made in that stock. Now it's Tango that's doing it. So yeah, I mean, what we did was we sat on the position, and fortunately it recovered all the way almost back to break even where we got out yesterday. So what could have been a huge loss ended up being what we sold it out at like a -2% loss or something. And then it can do whatever it wants to from here, but my interest in it is considerably less now that I can see that the market making that goes on in the stock is a bit questionable.
Yeah, and you've seen it spin around before, this big move up. So other than that, it's a good-looking base here. You got a shakeout here, but that kind of creates problems. On the other hand, Jazz did go higher after it had that spin out, but I don't know. My thinking is this is a big spin out it had, and of course it corrected, okay, and then it came out, was very choppy, and finally went to new highs, and now it's just kind of basing. But better to be safe than sorry. When you see stuff like that, a lot of times that is a problem, and you don't really want to expose yourself to that. That's just the way we approach it. If you like living dangerously, you can hold the stock. Somebody's asking, we talked about Monster. Somebody's asking, it was above the 10-day moving average. Now Monster is just a little below. Is that a sufficient amount to initiate sell? Well, you're not using the 10-day moving average. You're using the 50-day moving average as your guide. So, and we discussed this, so I hope that answered the question. I'm coming down the list of questions here.
Yeah, although, on Monster, so it violated it on February 16th. And so we're on 1, 2, 3, 4, 5, 6. We're into the 7th week of Monster, where it's holding the 10-day. I would like to point out also that on March 7th, that is not a violation. The low of March 6th was 56.33, and then the low of March 7th was 56.25. Generally, you want to see at least 10 cents, if not a little bit more. I mean, in rhythm with the pattern. So in other words, you don't want to just sell automatically if it goes 1 cent below. You want to give it a little bit. Usually 10 cents is generally the cushion that I give these things, which is, of course, not much to give back. So that would not be, March 7th would not be a violation. However, February 16th would be. So we're on the 7th week. If this completes the 7th week without a 10-day violation, then I would start using the 10-day as my sell guide.
Yeah, it makes sense. You can see the market's actually holding up today. I think what happens after the gap down yesterday, everybody comes in and sees it, and a lot of people get scared out of certain positions. I think what you do is you only sell if you're hitting a sell point, if you have a leading stock and you're up on it. If you're underwater on it, that's a different story. You got to cut losses and I think keep gains from turning into losses. Somebody asked to repeat the emerging markets inverse ETF. That's EDS. Just think of ED as in Ed Sakota. So think of EDZ, EDS, EDZ. Got it? That's how you can remember that one. It's actually Sakota with an S, but we can say Ed Sakota. Get it? With a Z. Anyways, that's your, what do they call that, Dr. K? Your
mnemonic.
Yeah.
Mnemonic for the day.
That'll help you remember EDS. Just think of Ed Sakota, the great trader. Anyways, okay. Blah, blah, blah. What do we, Tango, we went over Tango, we went over TVX. Yesterday, the SLB stole my Tango at the open. Any suggestions against protection against that? Yeah, don't own it. That's how you protect against it. That's how we unloaded it. But one reason why we don't set mechanical stops, we don't set a stop that an automatic stop loss order, because a lot of times that's what will happen. I think it's just lousy market making. And I think probably a function of the electronic trading. That's one of the reasons why we're talking about with LinkedIn, how if you could slide, or Monster, you could slide a little bit past a certain low that you'd be using as your guide for a stop. And I think a lot of that can happen with decimalization because things really spin a lot. It's not like the old days where you would see something, trade at a quarter, a quarter, a quarter, a quarter, boom, then it would go to 3/16ths, or I'm sorry, 5/16ths, and it would trade at 5 teenies, 5 teenies, 5 teenies, and then boom, then it would go up to 3/8. And you'd see stocks ratchet up that way much more coherently. In the thinner stocks, of course, there's always more volatility, but now every stock does that. And the way things trades a lot differently intraday, I think, so there's a potential for more spinning and things sliding past, some of your stops. That's why you have to allow for this concept of what Dr. K calls porosity. Anyways, Dr. K, when the market direction model switched to neutral, how do you decide which stocks just to blow out versus which to continue following your 7-week rule? I think we already covered that.
Yeah, I mean, it's a question that, I mean, the selling side of investing is always the trickier part. So, we do get some questions that are repeat questions because I think there is a bit of confusion as to exactly what to do, and that's what makes selling challenging. Is there is no hard and fast rule. It depends on a lot of factors. It depends on how long you are the market at that time. I mean, if you're 180% long the market and the model switches to neutral, that might be well beyond your risk tolerance limits, and you might want to size down and take yourself off margin, especially if the model were to go to a sell. On the other hand, maybe you've got a lot of your position concentrated in one or two stocks that you have a huge profit cushion on. In that case, you might not want to touch your portfolio at all. Just leave the stocks be. The MDM is focused on ETFs, and sometimes you get false signals in the market calls. So if you've got a couple stocks and they're not doing anything wrong, you might not want to sell a share, and just wait for those stocks to hit their sell stops before you take any action. I tend to prefer to wait for my stocks to hit their sell stops, primarily because I'm focused in leading stocks, and they stand the best chance of bucking market downtrends or trendlessness. But that said, it's conditional. I mean, if the markets are looking very weak on on a sell signal, then I might pare back some of my positions and take myself from a high level of margin down to a lower level of margin. So it depends. It's contextual, and it depends on the trading strategy of the individual.
How are market timers doing this year, Dr. K?
Terrible. Apparently, well, I haven't actually looked at the latest top 10 performers, blah blah blah. I just know that the market trend following wizards, and these are a group of individuals. I think there's about 15 or 14 of these guys that have been interviewed in Jack Schwager's books, and as well as Michael Covel's book called Trend Following, a very excellent book, I might add. These investors as a group are collectively down as of end of February, I think, or no, I think end of March. That's right. They're still collectively down. The results just came in. That doesn't mean they're all down. Some of them are up, not very much, and some of them are down. But collectively, I think they're off a percent or two. So it just goes to tell that the market is not, even though it's been in an uptrend, it's still not a normal, easy environment in which to profit from.
No, I think though you're also dealing with anomalous markets that are QE related, and I think a lot of the models are based on historical data and probably fit better to previous periods where you didn't have QE.
Yeah, the QE certainly muddies the waters clearly, and I think that's why virtually every model that I followed that had a good track record that goes back a number of years, just some of these models just died after 2008. In 2009 when QE began, they couldn't factor QE in, and so they've been underwater since 2009. And some of these models had great track records going back 10 years or more. And then there was just, I won't mention names, but there was one recent model that was just like the last man standing up until the middle of last year, I'd say June 2011. It was the last man standing, and then in the last half of 2011 and this year, it just completely is gone out of sync with the market. So it's a very unique, interesting environment we're in, and hopefully we can keep standing. I don't. If anyone knows of a model that has done well for several years at least, and continues to do well in 2011 and this year. I would love to know about it because I'd love to know what else is out there. And I've studied hundreds of these models, in cyberspace, all these claims and whatnot. And there's always flaws. There's always flaws if you look, if you read the fine print and you really look at the data hard, you can find the flaws and the weaknesses in the model. And the weaknesses are generally almost always, I would say, not venal, but they are mortal errors. They're not benign. So, but if anyone knows of a really robust model that's been great all the way up to present, I'd love to see the link.
I had some observations on Apple here, which I think is interesting, and it's one stock that's holding up. It did close once below the 10-day moving average, so technically if it had moved below the intraday low here, which is 597 and 94 cents, that would have been a 10-day violation. And you are using the 10-day moving average as a selling guide on this. Is that correct, Dr. K?
On Apple, I'm using the 10-day because it's just managed to, for weeks and weeks now, well beyond the seven-week minimum requirement. So once it violates a 10-day, that'll be interesting for the market. I think that might the model actually weighs in leading stocks fairly heavily, especially when they're performing like Apple, because Apple becomes the market, so to speak. So if Apple were to have a 10-day violation and the model were not yet on a sell signal, that might be just enough to push the model into a sell, just that one little factor.
Yeah, but it's acting very powerfully because on Monday you had a big gap to new highs. It wasn't a viable gap up. On what basis? I noticed it just barely cleared 0.75 of the 40-day ATR, which I think was 1055 on this day before that move, Dr. K. Why was it not a viable gap up?
On the 3rd? April 3rd?
Yeah.
Well, it needs, first of all, the volume rate was only 33%.
Okay.
So it really needed 100. It needed 50%.
But you notice, so it comes back in yesterday and fills a gap. You have very light volume and fills this gap and closes at the peak of the range and is holding very tight. Now, it's possible that even if the market were to get into more trouble here, that what would happen is a stock like Apple, being a big leading stock that everybody's got to be in, could just go higher. And you've seen that before. I can just show you a good example within, if you go back to the market in 2007. Let's see. eSignal decided to get slow on me. There we go.
Actually, I'd make a comment while that's loading. These gap ups, we have that ATR rule, but if a stock has a lot of these gap ups in the pattern, then that's not a viable gap up. A viable gap up is a very special event in the price volume action of a stock. So I would say on the basis of April 3rd's gap up, that's really in context with the whole pattern. It doesn't make it a viable gap up. It just makes it a mini gap, which is a sign of strength.
Okay, let's see. What I'm going to do is go back. You can go back to 2008, and I just remember this one from back then. Let's see. Keep going. Here we go. 2008. You can see that the market topped in late October and broke down very rapidly into November, then chopped sideways into the end of December, then really broke down into early 2008. At the same time, at the end of October, First Solar came off just a hair, and then it gapped higher, and it continued higher even as the market was starting to roll over. And then it finally topped, coinciding with this break in the market here. So what happens is you could see Apple continue to go higher, and the market could top, and start to break and then chop around. And as it's chopping around after the first break off the peak, you could see maybe Apple continue to go higher. And then when it finally tops, then that's where the next leg starts. So that's just one potential scenario. But that's why I think that you don't want to get into this mode where you have to run for the hills necessarily, unless you're very fat and you're very happy right now and you feel like, blowing it off and taking some time off or something. I guess you could do that. Let's see. Thank you for the EDZ. Livermore Century rule with LinkedIn. No, because it's already gone above 100 before, so I won't use that. I also wouldn't really get too bogged down on that in most cases. There are other rules that you can use for buying these stocks that work just fine. Let me see here. Somebody asked about SAVE. Did we talk about this one yet? here's another one of these spinouts here, which makes it suspect. But look at the thing is breaking out again. So it's broken out. It's acting okay. Nothing really to say there. I would say for the most part, just acting well and pulling in. Gil, do you think the long-term story is intact for INBN? And is this? I have no idea about long-term stories. All I know is what the stock is doing. So like I said, if it violates the 50-day by moving below this low, it's a sell. It doesn't matter whether the long-term story is intact. All I know is that the technicals aren't intact, and that's enough for me to say, hasta la vista if this thing breaks down. And I don't really worry about it. So, if the stock is acting well, I want a good story to keep me in. But if the stock starts to act bizarrely or doesn't follow through with what I think it should be doing, then I'm gone. So there's no reason to worry about whether a story is intact because the technicals aren't. So that's what I would say. Would you agree with that, Dr. K?
Sounds about right.
Anyways, let's see. Going through some more. Look at PMTC. Yeah, Parametric Tech looking okay, and then they came and guided lower. And there's some danger in this. This thing was looking okay. Had Bible pocket pivots, Bible gap up here, and now of course you broke that, and you've gapped down. But they lowered their numbers, I guess, and they're getting chopped up. But I think it's telling you the inherent danger in this market right now. SWI also. We had Solar Winds buying it in here on the base of this pocket pivot here. It comes in a little bit and moves out, and then boom. When this happens, we're gone, and we're not messing around with it. It does rally back a little bit, and they always do that just to tick you off, and then it goes lower. Because the market does know who you are. It does. Everyone has a name tag, and you don't know it. But whenever you open an account with a broker, you get a special ID, and the market knows who you are, and it will do things just to tick you off. Just so, for those of you who ask. Right, Dr. K, the market knows who you are, right? Didn't the market recently
that would be something. Now, wouldn't that be something? Isn't that called cornering the market, I guess, if the market really knows who you are and cares?
No, all I know is if the market ever shows up on your Facebook page and wants to be your friend, do not confirm. That's just
run for the hills.
Yeah, really. Anyways, there's another one. I don't know about. Is this support? I don't know. It's violating. It's below the 50-day. So if it breaks this low, and violates the 50-day, guess what? It should probably be unloaded. We didn't like this because I don't like something when it breaks out and it fails on the breakout. And then so we just get out. Gnarly. How about the IBD 50 for what? As a short? I don't know. I don't know what that question's about. That must have been contextual to something we talked about. Let's see here. Bankrate, it's not really a stock we've been looking at. You got anything on this one, Dr. K?
Let's see. Rate. Well, it's been first. Yeah, I'm not crazy about it. It's got a lot of flaws in it. In terms of the market's been in an uptrend, and this hasn't. This has been a weaker sister. The relative strength is 93, but in a good trending market, you want to be in stocks that probably have a high relative strength of 93. This thing went and undercut the 50-day moving average, and then it's had a wedging pattern, and now it attempted to go above that, but now it's heading back into the basing pattern. I mean, there's better stocks out there, and this doesn't excite me one bit. The earnings and the sales are great on this thing, but there's other flaws. There's flaws in the stock that just make it non-actionable for me.
Yeah, same here. So, not one we really care much for. Okay, for a violation of 10 to occur, does the stock have to subsequently close below the low of the day? The stock breaches a 10 there, or just move below the low intraday?
Just has to move below the low intraday.
Yeah, but in some stocks, you can wait to see how it closes, So there is some, if you're going to allow some porosity. Again, though, people want a black and white rule, and when you're using those rules in terms of a moving average violation, depending on the nature of the stock, it's extremely, or tends to be more volatile. I'm not going to say extremely volatile, but tends to be more volatile than your average bear out there, or your average stock. Then I think you give it a little bit of room, and so you can wait to see how something closes. And obviously, that's what you would want to see, I think, in most cases, but I know I said something, I made a comment out there, Dr. K, about on Apple, I want to see it close below that with Apple, it's some stock I'd want to see close below there actually, because it does have a tendency to get support from the market and from institutions. I think somebody took that and went nuts with it, thinking that I had stated that the rule is that you have to wait for the close. But I was just talking about Apple as a
Yeah, and it's contextual. With the case of Apple, since there's so many institutions on the stock, I mean, if it goes below a certain level, you will get that support coming in, so you can wait for the close in the case of Apple. But as a general rule, you know, a violation on a moving average occurs when it moves below intraday the low of the closing day.
Yeah, like here's a good non sequitur. There's a simple model that's been successful since 2009: buy and hold Apple and nothing else.
That's right.
Good. Especially if you can operate with 20/20 hindsight at all times. I think that definitely is the case. Dr. K, does your model take into account global markets? I would say no, but
well, it depends. It's contextual. I mean, in this case, Europe, the focus has been on Europe, so the model definitely looks at what's going on in Europe as part of its weighting right now. In the past, Europe made zero difference to the model. Europe could do whatever it wanted to do, but these days, you know, there's a lot of debt problems, a debt crisis in Europe, and we're waiting for the next dominoes to fall. And if they fall, is that going to be a real big problem, or is Euro QE going to be able to counteract it? So the model is clearly weighing in European bourses.
Somebody asks, is Coors viable here? I'm not really sure why it would be viable. There is no pocket pivot. There is no breakout. There is no buy point in here. You have this big volume here, so you're only looks to be 9 days out. So you'd be waiting a couple more days to see if there's a pocket pivot. You'd be waiting for a buy signal before you buy it. So I mean, we can't really give you an opinion on whether we think something is viable here or not. It's in a base. It's trying to build a base. That's all you know. It's pretty tight, and you're just looking for the next buy signal, which in this case, it looks like the earliest signal you could have would be a pocket pivot buy point off the 10-day moving average, but it would have to be bigger than this volume unless we get out another couple of days, which is also possible. So, you know, keep an eye on it, but it's not viable right here. Tibco is interesting. Yeah, Tibco's a stock that I've liked since it had these pocket pivots down in here, and it slowly worked its way. It has these spin-outs. They came out with earnings, they broke the stock, and now it's turning around and going back to new highs. I still think this is a great story, and the thing is very resilient. So, you know, the thing is you don't have a buy point in here because you have all this volume. So for there to be a pocket pivot today, the volume would have to be higher than this, and that would be the case for the next 6 days going out. So that's really all you know there. But I think it's interesting that it did break hard on earnings and then found support along the 20-day moving average, I guess, which it did here too. It closed below but did not violate. But, you know, it's a little bit choppy up here. I would tend to think that it needs some time maybe to go sideways for a bit. So if the market did get into like corrective mode here, it might be constructive to see the thing build a base and go sideways from here, because it has been up, you know, 1, 2, 3, 4, 5. I don't know if that's really an up week there. All but this week, actually. So all of these weeks have been up weeks, and you notice where it's come down, you see it close in the upper part of the range, and it's doing the same thing. So it's really not too bad. But on the other hand, it's a choppy ride. But if you're buying down in here, coming off this flat area on this pocket pivot and this low base kind of breakout thing, because it was very tight along the lows there, you're still doing okay with it. But this is kind of interesting. Let's see, more questions. Please explain ATR rule. Dr. you want to explain the ATR rule?
You take the ATR, average true range. Actually, if you Google it, you'll get the exact formula. Google average true range, and you'll see exactly what the definition is. But in essence, what we do is we look at the last 40 trading days, and we take that average true range over the last 40 trading days, whatever that is, and the Bible gap up rule says that for a Bible gap up to qualify, it has to be at least 0.75 times that 40-day average true range. And I think we have some detail on it in the FAQs as well.
RAX is pulling back to the top of this breakout here. So that's really all it's doing now. It's not a lot of volume on the breakouts. There's no real pocket pivots in here. This thing's gapped up and then pulls in and shakes everybody out and then goes higher. But so far it's trying to hang in there. On the weekly chart, that's really all you have going on. And you could pull back to the 50-day moving average. That would probably be your guide for the stock on the downside at this point. But I would like to see it hold the top of this consolidation on the pullbacks. In other words, find support here. And if it doesn't, that could be a problem. I don't know. But it is a squirrely stock. You got any comments on RAX, Dr. K? You've liked it.
I liked it once a long time ago, and then I really started hating this thing because it tends to push you out and then bounce back. It undercuts and violates the 50-day. Starting in June of last year, it just hasn't acted right. It's just been a tough one to buy. And then when it finally broke out, that was actually the first time in the price pattern where it actually settled down and was constructive. So we're talking February of this year, where it had that really nice breakout on big volume, and then it had a subsequent gap up, which you could call a Bible gap up. However, it undercut that by more than the 1 to 2% porosity, forcing you out again of that Bible gap up. If you bought on the breakout, which was on February 2nd, then you should still be in this stock if you're using the 7-week rule, because it violates the 10-day in March within 7 weeks. So then you would use the 50-day moving average.
Right.
And I would say that back in we're talking in 2010 into 2011, it had actually a very nice uptrend where it never violated the 50-day. So you could have had a double play in the stock where you could have bought it in the teens or 20 and sold it probably around the 40 level several months later. It's a tough one though, because if you look at the pattern when it sells off, sometimes there was a gap down on January 20th, 2011 that I might have been selling it right at the open, without it having a chance to hit the 50-day. And then it just refluxes all the way back up to new highs again. So it's a kind of a tricky, messy pattern. But right now, if you're sitting on the stock, I would be using the 50-day as your guide to sell it.
And that brings us to F5, which is he's continuing to move higher, but you're using the 50-day as well on this as your selling guide because it doesn't hold the 10-day long enough. And it's acting okay. I mean, it's just kind of chopping its way higher, but not really coming apart. You didn't even really get very heavy volume on the sell side, a little bit above average, but it's lighter than the prior day, and you close up off the lows. So it's almost like you got a little bit of support there. Another one of the cloud stocks that is holding in is VMware. It actually had a little bit of a pocket pivot here, and I guess another one slightly up from the 10-day moving average, pulling back into the 10-day moving average. But I think, has this one held? Would you be using the 7-week rule on this one, Dr. K, or is that even relevant?
Well, I don't like the pattern prior to the breakout on March 13th. That prior pattern is just really sloppy.
Yeah.
And the relative strength was also 67 prior to that breakout. So I wouldn't be touching this kind of stock in this kind of market where there's faster horses out there. I mean, this thing. If it keeps uptrending like this and respecting the 10-day, I'm going to be very surprised because the history of the price pattern shows it doesn't really like to do that. It doesn't like to obey the 10-day. So if you're in the stock, I would say keep your stops tight on this one. I mean, right now it's in a nice little uptrend, but I wouldn't expect it to last very long.
Okay. So you don't like it?
No, I don't like this one. There's better ones out there.
Yandex. No, this thing's in an ugly pattern. You don't want to buy this. All right, Dr. K.
Yeah, this market, there's better. You don't want to bottom fish in an uptrending market.
UBMT. I know. We talked about this thing. It's just real volatile. So if you buy it at the right spot, I guess, on pocket pivots, and you can hold. If you sit through it on the pullbacks, I guess you can play this one. But it's pretty squirrely. But it's acted okay, and you guys may all remember I first told you about it or talked about it right in here, and it's moved higher, but I've never owned it. I think maybe I did own it for a little bit, and just this kind of action is just really funky. You don't have any comments on this, do you, Dr. K?
Yeah, it's a sloppy pattern. It's got a lot of upside, and it's a very interesting story as well. I mean, it's got a lot of things going for it, except for the pattern, which is very sloppy. This reminds me of some of the semiconductor stocks in the late '90s. I could never make a dime off semiconductors. I made a lot of money off these other ones, but not semiconductors because the patterns tended to be too sloppy. So I would get pushed out of my position, and this is, I'd say, potentially sloppier than a lot of those semiconductors. So I'd be weary about this one in terms of my own trading strategies.
Somebody wants a blog for the webinoids. I don't know. That's a lot of time. I don't know if I have that much time. I make more money trading than babbling to people about the market, to tell you the truth. So I don't know. I don't think so. Red Hat looking like it's trying to form a tight flag 1 week so far. That's about it. Yuri, so United Rentals, still not a fan of this stock. So it's acted well here. It's just basing. Anything, Dr. K?
Nope, pretty much says it all.
Okay, and then SXCI. SXCI, we saw this pocket pivot a few days ago, but of course it's drifting back in. So I guess if you like this stock, SXC Health Solutions, I guess you could buy it here using the breakout as your stop, I guess. But we didn't talk about it because it didn't really thrill us that much. Express Scripts, another breakout. I think a lot of these, or some of these, are doing well, and some of the news coming out that the Supreme Court has been hammering Obama's attorneys on their arguments. And if you look at their arguments, they're kind of stupid, and they contradict each other. And that I think the judges are starting to pick up on a lot of that, and that the whole position of the government is really kind of deceitful at best. And you're seeing some of these rally, I think, on the basis of that. And you've seen a number of healthcare-related stocks doing well. So, I mean, that's all there is. Are we all over it? No. GNC hasn't done really much anything since the Bible gap up. You did have like a pocket pivot in here, just a small one, and it continues to just kind of truck slowly higher. So it's acting fine. Nothing really wrong with that thing right now. So Zynga's, I think, a dog, and it's not really coming through with what we thought it would do, and so it's actually violating the 50-day moving average. So we're not in it.
Yeah, I mean, and again, this one I'd said in a prior report, or actually webinar, that it's a very competitive space now, and they really need something above and beyond what all the competition offers to distinguish itself. It's not like the days of NetEase and Sohu and Sina, which were brand new spaces in the Chinese internet gaming market, where they had a much clearer run, and that's why you saw these all three stocks, I think, were 10 baggers. I think they all went up at least 1,000%. But now this is not 2005. All those stocks, I think, had their day 2004 to 2006, somewhere in there. But here we are, 2012, and as we all know, the internet technology on the internet moves very fast, and it gets very competitive and very crowded quickly.
Let's see. FSRX is up on merger with Medco. Oh, ESRX. Okay, well that may be it. So, but again, we're not into it. Fossil. Yeah, it's acting okay. I guess you would call this a pocket pivot, but just acting fine. Bed Bath & Beyond. Is that a Bible gap up, Dr. K? I don't think it's enough volume. Doesn't look like it to me. So I wouldn't consider it that. They already broke out here.
Bible gap. Well, it's probably going to be. I mean, the volume will probably be enough for today. Yeah. I mean, that would be a Bible gap up, but the pattern doesn't really excite me on this one. It's been a laggard, and the relative strength, I think, what is this? Is it that low? Relative strength is, yeah, it's 81. Again, in a trending market, I'd rather have a stock that's poses more potential. And if you look at the weekly on Bed Bath & Beyond, it's a messy pattern for years now. It's just the nature of some of these retailers is that they don't go in clean patterns, and therefore it's tough to make money off a stock like Bed Bath & Beyond.
Yeah. Very trip. Hmm. Yeah, I've been looking at this one, and it's not really. I don't know. Their earnings. I know TripAdvisor. I use them, but their earnings aren't really there. 14% earnings growth, 10% next quarter. It's actually decelerating, and so it doesn't even have the fundamentals really. I
Yeah,
mean, it has
had
kind of
that gap
numbers.
down as well.
Yeah, it's kind of junk to me. Let's see here. Fire, source fire. I mean, all this thing has done is gap up, and it's just continued to hold up. So that's all there is. There's no other buy points. If we ever see a pocket pivot, we'll let you know. But other than that, there's no other buy points there, and it's not really breaking down to the point where I would consider it a sell necessarily. So let's see. Um, liquidity. I know this one. I think this is one of Ross's favorite stocks. Liquidity services. Just I don't know. Do you like this? This one's too squirrely for my taste. I mean, it does a lot of, runs up, breaks down, runs up. I'm not really into it.
Yeah, it
How about you?
violates the 50-day moving average routinely, and that's always a warning signal when you have that in your pattern. Again, it's kind of like a Bed Bath and Beyond. It's going to be a really hard one to make much progress on because the idea is you don't want to be day traders or swing traders. You want to be position traders. You want to be able to ride a stock for weeks or months, and to be able to do that, that stock needs to be able to respect at least the 50-day moving average. Ideally the 10-day, but at least respect the 50-day. And there's enough leading stocks that have done just that. So you want to keep your eyes out for those types of names.
Yeah. Z. I knew someone was going to bring that one up. I think it's kind of interesting. If you like, since we don't like Zynga, I guess we can go to a different Z stock now. But this thing came public back last July, and all the way up to $60. Suckers, and they sold it to them. So I would call this the top of the base, and of course here you are breaking out of the top of this base. Let's see if I can get this all in. Yeah, here you go. That gets it better. And you break out. You could draw a trend line here across the top if you want, something like that. And you notice it breaks out through it. Big volume pulls back. I think there was some news that they are going to be listing on Yahoo, so I think that's considered a positive. So it pulls back to the trendline breakout. So I mean, it looks okay. Nothing spectacular. They got some decent earnings. May go higher. You got like 1.5 million shares sold short on this thing, and it's got a 5 million share float. So it's a thinny. It trades like 334,000 a day, but it's possible if you have a small account, you could hack your way into this and see if you can get a short squeeze. But it's coming out of this base breakout. I would call this a base breakout. I don't think this action, I don't know how many idiots are in here that bought it, but a good reason why you never want to buy a stock on the IPO day. Dr. You got any words of wisdom on this guy?
Yeah, well, I would say that this is not a bottom fishing pocket pivot simply because
No.
it is an IPO, and you take out that first day, and what it looks like is it is trying to make a breakout at this level. The earnings and the sales look good, and overall, it's not a bad stock. I mean, there's better out there, but it's not a bad stock. If you wanted to put a little bit of your portfolio in, it's not a again, it's not a cardinal sin to do that.
No, it's not. And it's actually breaking out. I would expect it to hold the breakout, hold the trend line. And you notice it has. It sold off down this morning as well and yesterday. And, of course, it's a thinner stock. So let's see. Pushing through. BNNY. Bunny. I like that. What the heck is that? Oh, let me get this. What's going on here? Is that for real? It is. Annie's Inc. Now my e-signal has decided to block out. I think you freaked it out with the symbol. Oh, there it is. There it is. Okay. I don't know. It's an IPO. It hasn't had time to build a base.
Yeah,
Look at
and the
that. That's
earnings
what it
don't
looks
look
like
real
on
good
the
on
weekly
this.
chart. So, you don't want to mess with this.
Yeah, I don't like it, and the earnings are pretty poor. Sales, nothing exciting. There's nothing exciting about the stock unless there's something in the story that really makes it compelling. But just looking at the description, I'm not seeing it.
Yeah.
It's interesting, though. I will say this: it's interesting how the IPO price was 19 and it gapped up to 30 something. So maybe there is something unusual about this stock that I'm unaware of. But I don't like the earnings. The earnings are
Annie's, they make
decelerating.
they make food. They actually make soups, and they make some gluten-free soups that I like. I think they make a great tomato soup that's pretty much gluten-free. So, I'm all for them, and they're expensive soups, so I don't really know. And there's a bunch of other products they make, but it's like Annie's Organics or something like that. But anyways, that's basically what they do.
Pretty bizarre that they gapped up so much on IPO day.
Yeah, but I don't know. I mean, they're good soups. I really like them. I think the tomato soup's the best thing I've ever had. But if you're into tomato soup, which I am, but that's that drill. Let's see. Let's go through a couple more. Priceline. Now we talked about Priceline. You had two pocket pivots there. So here's another big stock. You're using the 10-day moving average as your selling guide. It's like Apple. It doesn't want to break the 10-day moving average. So I would be surprised if Apple and Priceline don't end up topping with a climax top. So what attracted you towards WDC? Pattern seems pretty shaky. Well, I talked about that on the Gilmore report. It has nothing to do. Okay, Dr. K, you got to get going, don't you? You got a flight to catch, don't you?
Yeah, yeah.
Yeah.
So yeah, it looks like the hour. Actually, it looks like we've gone an hour. It's amazing
Yeah.
how fast these hours go by.
Yeah.
They're a
So,
lot
all
of
right.
fun.
Well, you take off, and I'm gonna just finish up real quick.
Okay.
So.
Well, I'll be in range for the next basically next 2 to 3 hours. I'll be on my portable laptops. So
Okay, on your iPhone, in other words. Okay,
yes,
sounds
and an
good.
iPad. All right. So long,
Uh,
everybody. Have a great Easter weekend.
I don't know. Why do you? I think it's curious why you have to ask me what attracted me to WDC. I never bought it, but I did notice you have a breakout here, so that's huge volume there. You also have a couple of big gap ups, so that one seems kind of obvious to me. But you're getting the pullback right into the 50-day moving average and into the breakout point now. Is this thing going to hold? I think with PMTC and I don't know, maybe a couple of other chip stocks getting knocked around. That's EMC, which is a memory stock. WDC is big data storage, so like EMC and a couple others like that. But I don't know. It's pulling in. Is it buyable up here? I guess you could try and buy the pullback. But I just noticed the breakout. It's a nice big breakout, so it looks kind of interesting. MFRM. Mattress Firm, I think it's doing like what all the other mattress companies are doing. Tempur-Pedic continues to go higher. And this stock is just continuing to truck higher. But, it looks okay. It's an IPO. You don't have any buy points in here, though. This might be a pocket pivot still extended from the 10-day, so no real buy points in here outside of maybe this pocket pivot in here. So, but right now it just continues going higher. TJX. Continues going higher. Not much to say there. Is it going to have a pocket pivot today? I guess we'll find out. Oil plays, CLR, Continental Resources. It's along the 50-day. I'm not really into these. We talk about these all the time. Contra Resources, another one that's living below the 50-day. Pioneer, you have pocket pivot coming up above. You could try and buy these. We don't really favor the oils, and we've talked about them many times before, but they just tend to be very choppy trends and just like very tough to play. So that's some people are asking Dr. K, what are your favorite stocks? What stocks do you two think should be on our watch list? Well, the ones we're talking about. So. I just think you should watch the IBD 50 or the 85 index. My watch list is any stock with a composite rating over 85 generally, but the IBD 50 is a great watch list. 85 list is a great watch list. So any of those areas are fertile ground for buy ideas. So I don't know if we have any favorites. So like LinkedIn, I think Apple's probably just going to keep going higher in perpetuity. And I don't think there's a single person on TV who thinks it's going lower from here. So the crowd can stay bullish on something for a long time. So that's what it looks like to me right now. STFV, what is this? STVT. Is that for real? A tiny stock that holds its bottom trend line. Oh, this must be some junk. This is junk. Not playing. Organic mac and cheese. That's what Annie's is. Oh, God. Dang. I don't know, I think you buy, what is that? You can buy Tango. So you got Wango Tango, and you can buy Dang, which is, I guess, Wang Dang. Sweet Poontang is another Ted Nugent song for you Ted Nugent fans. That could be the Ted Nugent portfolio. Dang and Tango. Cheap stock. Coming up off the lows. Junk. Don't play. Chart looks good. Well, I mean, if you look at it this way and you exclude the fact that it's trying to come up off the lows and it's really a bottom fish, that you need to look at the weekly charts, I think. So, somebody says have a great long record. I know somebody says WDC sales record doesn't look good. Their sales growth is spotty, but they've got big earnings going forward. Expected to make over $8 next year, so there is some big growth in there. And the other thing on WDC that I think is a big positive are these big gap ups on big volume, the big breakout here. So, but it doesn't mean it has to work. So, do you have any prime short sale candidates? Yeah, there's some things I'm looking at, and I guess I'll get to that portion now, since we're running out of time. The 8585 index, you can go to investors.com and it'll be there. It's also on IBD. It comes out every Friday, I believe. Here's one I'm looking at, Aruba Networks, breaking down on the weekly chart. Big head and shoulders, you know, it might start to break down, but I'm watching this. If you get a little bounce in here, that's a possibility. But again, we're not really in short sale land yet unless we get into a bear market. Now, something I still keep an eye on Amazon, because it's trying to come up around, and last week I said I liked it if it holds. I like it long, and I was actually trading in here if it holds above the 200-day, but now it's broken below the 200-day. You had a pickup in volume here, and you gapped down a few days ago. I did play this. You rallied back up in 200 days, so I got short in here, and it gapped down, but to me this is just a short-term trade. It may find support here and bounce around for a while, especially if the market doesn't blow to pieces. So I'm not in the mood necessarily to be shorting it here. It's a quick couple-day tactical short. It was nice, but nothing really thrilling there. The other one we've looked at before is DEC, and it exceeded the downside price target, but it's not, you know, it's not really rallying. But it's a dog as far as I'm concerned. Whether it's able to bounce back up into this area towards the 50-day, it's a possibility. But I think at this point you've probably gotten the heart out of the watermelon on the downside. So, but there's not really, and you can see the market turning higher. There's really not a lot of short sale setups out there. I thought some of these could be, you know, like a big pod type thing, and you see it breaking down. Of course, you can short these rallies, and it breaks for you. Now you're long support. Maybe this takes a little more time to develop. You know, a lot of times they'll start to break down and go choppy sideways for a period of time before they break down. So, Sturm Ruger is still going higher. Nothing really to point out there. Lulu continues to hold up. Surprisingly enough, let's see, little violation of the 10-day there. So I think at this point you're using the 50-day as your selling guide. Discuss being wrong most of the time. You know, I don't know. I've had periods where I've been wrong for a long time, and I'll give you one example. In 1995, we actually had a follow through in December of 1994, and the market continued higher. And by May of 1995, I was down 32%, and I just kept buying stocks that looked good and they didn't pan out, and you get dinged. And then finally, I jumped on C-Cube Microsystems and ended up 520-something% that year with just one stock. So it was really a matter of hanging in there and being wrong a number of times and actually dropping off a bit, and then being right once in a big way. And that's really how that works. And even last year, I would say most of our trades didn't work out well for us, but we did finally catch on to the move in silver, and using the AGQ, we were able to go up very quickly and end up for the year. And that was kind of the saving grace. And that's kind of the situation in most markets. It's one or two or three stocks that really do all the work for you. And if you catch something that works really well, and I know a number of people who are up, you know, 100% or more this year already because they bought Course and bought it and played it, you know, pyramided it, and have a big position in it, and they're fairly concentrated, you know. And I know there are some guys running around emailing people and going on Facebook and talking about how much up they are this year, but it always brings back a story of when I first started running money for O'Neill. In the first quarter that I was running money for O'Neill, I was up 45% right off the bat, and I thought I was doing real well. And the CFO of the firm comes in, and he's looking at my name on the report, and he says, "Oh yeah, Morales, you're up 45%. He says, "Anywhere else on the street, you'd be a superstar. Around here, you just average." And he walks out of my office, and of course I fell apart after that. Ended up down 30% from plus 45 to minus 30 going into October, and then by the end of the year was able to be up by 120%. Playing a couple of stocks, Schwab and AOL was another big one back in late 1998 that had a big move. So, you know, able to come back, but that gives you an idea, number one, of how you can screw up a lot in the market, and then you get your big opportunity and make huge money. And I think with Michael Kors, that's one example of a stock that if you played this one and you got this one, you can actually be up a lot. You know, so if you're out there and you think you're great because you're up 30 or 40, 50%, there are a number of people who are doing a lot better than you are. So no matter how good you are, and this goes for me and Dr. K as well, there are always a lot of people who are a lot better than you are. So I would remember that, and I wouldn't get too into running around bragging about how much you're up, because we're only a quarter of the way through the year. There's a lot that can happen before the end of the year, but if you've done well so far, I think you can pyramid that and parlay that into even bigger gains by the end of the year if you play it right. Anyways, that's why we're here, and we're pretty much done. We've gone over an hour, so thanks everybody for listening today. Dr. K is off to catch his flight, and we'll catch you guys next week. All right, take care.